Today I'm going to reveal the biggest reason why people hate the infinite banking concept, IBC. Most of us put our money in the bank, but the banks take that in, paying back double what you borrow. You want to see miracle results? Instead of Chase, Bank of America, it's the bank of you. Hey folks, Josh Levy with Real Change Financial, and today, as promised, I am going to reveal the biggest reason why people hate the infinite banking concept. Like most concepts online, especially financial advice, you're going to find two sides to every story, half detractors, half supporters, rather of a concept or a strategy. Our firm specializes in IBC, the infinite banking concept. No secrets there. All of our agents are owners of policies and use it to finance their families, and our hundreds of clients do the same. But truly the biggest detractor that people focus on is they'll tell you that the chassis of this strategy, meaning what type of account, is it a bank account, a savings account? Well, our money is being saved and stored and compounded inside a dividend-paying whole life insurance policy. That's a mouthful and a big turnoff because it has the word insurance in there, which itself deserves to be demystified, but that's only the chassis, the vehicle of this strategy. And when we drill down into this and look at some columns, and we're going to look at today, detailed columns of a typical life insurance illustration, we're going to understand why there is a factor that people hate, Dave Ramsey included and the legions over there. But what we find out is it's really a challenge of definition and understanding. This is not an investment at all. This isn't buying a stock. There's no element of risk here. And the element of reward is much more solid and predictable. The biggest attractor we're going to find out right now. Let's take a look inside. Here is a 30-year-old healthy male, a typical life insurance illustration. All will have some of these factors, but of course there are variations from company to company, design to design. But this is very common where we're paying $500 a month, $6,000 per year. At the end of 1 year, this gentleman will be 31 years old. He will have paid $6,000 out of pocket. His dividend is $76. Just going in order of the columns, dividend does not mean an interest earnings per se. It deserves a lot deeper treatment. We will cover that in future videos, but just to clarify, this column dividend is not an interest rate multiplied by a previous year's balance producing a dividend. More complicated, but we're gonna set that aside for now. Premium outlay is the new money coming in, so this is all gonna be out of pocket every year. That's why it's all $6,000. Cumulative premium outlay is showing us from day one how much have we spent on this, how much premium have we paid to be precise. And here it is. Zoom in, highlight, flashbang, fireworks. There's the culprit. Call the police. There's our first year's total cash value, representing the cash that we have after 1 year of ownership inside this contract. Folks, SMH, look at that. That's a $2,534 loss, i.e. a horrible investment. You'd be right. If we were calling this an investment, that would be a loss. So you're standing around the water cooler. There's Joe. He's talking about the mutual fund that he earned 9% on this quarter. Hey, great job, Joe. Here's Phil telling you about his 5% CD that he has in a bank that's going to be due in 2 months. What's he going to do? Tell you what he's not going to do today. He's not going to renew at 5% because the rates are constantly changing. Here comes Roger, who lost 10% on his stock deal. Bad pick, Raj. Hey, chin up. You'll do better next year, I'm sure. And here comes Steve, we'll call him. Hey, Steve, how'd you do with that financial product you were talking about? That one you bought? Yeah, you paid $6,000 for it? Yeah. How'd you do? Well, I've got $3,466 to my name. Oh, that sucks, man. You lost half your money almost. Well, there's the problem. Definitionally and legally, life insurance is not an investment. It's a purchase of death benefit for a future possibility of death, whether it's early or late, all the way to age 120. What Steve is doing is purchasing for $6,000, $568, $352 in life insurance. By the end of the year, it grows by that dividend that we looked at in column 4. So it's a contract to protect from an event called death. Now we're going to see what happens year after year as the features that happen in every single life insurance contract come to bear. Caveat, ones that are designed properly for infinite banking. Year 2, he pays another $6,000, $12,000 total out of pocket. $7,297. So we're closing that gap. Year 3, there's $18,000 out of pocket, $12,200. $24,000 in year 4, $18,535. $30,000 in year 5, year 6, 7. Between years 7 and 8, finally, our cash value surpasses the cumulative premium. Call it a break-even point. By the end of year 8, this policy has broken even, meaning to say there's more cash value than premiums paid in, and that will always be the case. Every year forward, he's just widening this advantage now. It was a gap before, but now every single year, there's a growth in that cash value by $8,500, $9,000, $9,600, but he's putting in the same $6,000 year after year. This is like a mature business. You know the run rate of this. You know that there's going to be growth every year, like a successful business, but there's no risk in doing that. These are technically non-guaranteed is the verbiage on the page, and that deserves some treatment. Non-guaranteed is required by every state's insurance commissioner, that any illustration is going to remind the client, the prospective client at that point, this is not guaranteed. Haha, there's the rub, right? There's the catch. Well, the catch truly is that though it's called non-guaranteed, the companies we work with, and in fact, the majority of mutual life insurance companies, have paid a dividend and not missed an earnings for 100 years plus. This particular company, almost 200 years. So in addition to the fact that we are now positive and growing and predictable, we have a growing death benefit associated with that. Again, in case of early death. So this contract, which provides so much more than just a cash value, albeit it takes time to ramp up, to be efficient, to be cash positive. Let's look at what Steve has here. He's got $6,000 out of pocket, $9,000 in growth. A few years later, $6,000 out of pocket, $12,000 in growth. A few years later, $6,000 out of pocket, $18,000 in growth. He has steady, predictable growth, and at a minimum, we use these types of policies, this type of design, to have passive income in retirement, down at retirement age, when there's hundreds of thousands of dollars of cash value. By the way, if you compare this to let's be fair, a 5% compounding investment of the same value, that investment is not going to be much farther ahead than the cash value of the life insurance policy. Of course, the early years they will be. They don't have the deficit of life insurance. But first of all, who's getting 5% every year? Read Barry James Dyke's book, The Pirates of Manhattan, any of that series, or Retirement Ruse, to see the real numbers on what the majority of people in America are saving. The conventional wisdom, your 401k, it's not making that 9% of the market supposedly makes in the long run. Taxes, fluctuations, and years in recovery after a crash or recession, depression correction, that 5% is even generous. And the life insurance will keep steady pace with that. In addition, having that death benefit, again, in case of early death. Finally, the piece that we haven't discussed is what do we do with our cash value? Well, that's our expertise in training what Nelson Nash innovative, using your cash values for financing your life. A car, appliances, credit card consolidation, vacations, mortgages, second mortgages. When this cash value is large enough and robust enough, has compounded enough, you can handle all of your own financing needs, and certainly those of your children, especially when our generation passes and the next generation inherits our death benefits. So folks, I hope that demystifies this argument, online battle royale, what's better, life insurance or investments, or hey, IBC is a scam. It's not a scam, God forbid. It's a measured process of becoming productive, of becoming a profitable banking system. And we can just think to ourselves, why does a bank exist? A bank exists to make loans and make money. And if we conceptually treat our own cash values as our own bank, the Bank of Steve, and he finances his life through that cash value life insurance, that cash value of his policy, all the interest that he was previously giving away to someone else's bank, in large part, will flow back into his vault of his bank and make that policy even more robust. That cash value grow even faster and accelerate even faster year to year. And if it's truly a problem for somebody to have to wait a few years to have enough cash in their bank to make some big money move, well, we design policies with a kickstart. See my other videos about keeping too much money in someone else's bank and how to repurpose that money, how to kickstart your life insurance policy, your IBC policy, with a significant amount of cash so that your bank is robust enough to purchase something that you have as an immediate goal. Again, I hope this was useful. If you enjoyed, like, subscribe, share, help us demystify this secretive topic of why everybody hates IBC, but really we feel they should not, and neither should you. Have a great day.